This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. I'm your host, Alex Perny, and today on the download, we have a relatively stable week in comparison to previous weeks this year. When looking at the securities markets, we have a lot of companies kind of rebounding primarily in the large indexes such as the Dow and the S&P 500, as well as the NASDAQ, all relatively rebounding from 2 weeks ago when we had a massive sell-off and an over 1,000-point swing in a negative direction and now into a positive direction in most of the major indexes. Not necessarily attributable to much. We do have some earnings reports coming out, which are helping to pad some indexes, namely the NASDAQ and Dow have risen rather high on the earnings calls that several large companies have put out. However, there are some companies that are still trading significantly lower, at least in the short term and in the longer 2-year term, that are worth looking at. A lot of investors have been very critical of most of the high runs that we had saw during the COVID trading boom. Things like Peloton, Fasty, Zoom, Teladoc, Novavax, and DraftKings, to name a few, all trading at relatively 100% of their high value during the height of the pandemic trading craze. So definitely some interesting things to look at from the perspective of when would possibly be a good time to buy. However, certain markets are still getting crushed, such as cryptocurrency trading at only a fraction of the volume that we saw even several months ago. We have Bitcoin trading at almost 2/3 of its value just from looking at back in December. We also have some interesting news in crypto. One of the largest Bitcoin scams that has ever been looked at prosecuting when they're in 2016, when over $3.6 billion worth of current value cryptocurrency, which was 120,000 individual Bitcoins, was stolen from a exchange called Bitfinance. 2 individuals have been arrested in connection with that heist and are now facing criminal charges in Manhattan, New York. So definitely some interesting things to look at with regard to cryptocurrency markets, and with volumes decreasing significantly and a recent find of a tranche of very valuable cryptocurrencies. It'll be interesting to see what happens to those markets here in the short coming months. GM stock sinks to a low towards a 5-month low after a long time bull analysis, and earnings reports coming out showing not as much growth as was expected. And we also have some movement from Tesla, although trading high. It is expected that the Southern District of California will be issuing an employment discrimination lawsuit against the tech and automotive manufacturer here to come soon. And lastly, the NVIDIA ARM deal not happening was not necessarily a surprise to a lot of investors, but still sending ripples through the large acquisition areas of tech. We are seeing Sony's acquisition of Bungie, as well as Microsoft's acquisition of Activision, as large moves in the technology sector, but with the large merger that was slated for the microchip and board manufacturer NVIDIA falling through, definitely showing that not everything is as green as once thought when it comes to acquisitions in the tech sector. Thanks for joining us for this edition of The Download. Today on the what is a non-recourse loan? Non-recourse lending is a form of financial lending where the individual borrowing the money offers no personal guarantee towards the debt. In this type of lending, which is a requirement for qualified plan retirements to borrow money, one must only utilize the collateral for the loan as the securing instrument for the loan in the event of default, meaning that if an individual does not repay the debt, the only recourse that the lender has is to foreclose the property and not come after any other personal assets of the individual borrowing the money, or the account in the case of an IRA, any other additional assets. This is non-recourse lending, and this is the what is. welcome to another edition of the Alternative Investing Advantage podcast. Thank you for being with us today. Today we have a great guest that's going to bring us some really insightful aspects on lending with IRAs, and not lending as in you lending out money, but actually borrowing money with IRAs. So if you're trying to make a deal happen, or you're trying to refinance out a partner, or you're trying to make something happen and you need some more money, well, if you've ever tried to do that from a high level, you understand that there's definitely some restrictions placed on IRAs for actually borrowing money within one of those tax shelters. There is a real specific way to do it. It's with non-recourse financing. And we have an expert today here from Titan Bank, Ryan Hughes. Thank you very much for being with us today.
Thanks for having me. I appreciate the introduction.
Absolutely. So Ryan, give us a little bit of background on how you kind of landed over at Titan Bank, and a little bit about what Titan Bank does at a high level.
So high level. So, I've always been in banking, large commercial banks, and Titan, they specialize in, like you mentioned, the self-directed, solo 401ks and IRAs, a small business bank, commercial bank. We've been around since 1907. And our focus has been all around, small, entrepreneurs, small business, and the self-directed space fits in perfectly with that. And of course, and then what we're going to talk about today, being able to leverage your retirement funds to go ahead and invest in real estate and buy out partners. So you'll be able to purchase more properties versus just one. You might be able to purchase two or three if you use a loan to go ahead and leverage that.
Yeah, that's a great point. And just so kind of people get an idea of this, is that when you have an IRA, obviously here at Advanta, we allow for clients to buy real estate. So invest in things that are an alternative to the stock market. So buying things like real estate, many other different things. But the problem with real estate is that it's an expensive asset. It's not buying a share of Apple stock for a couple $100. We're talking about, tens of thousands, if not hundreds of $1,000s for the purchase price. And not everyone has that amount of money to buy a property cash, or maybe they don't want to. Maybe you want to buy two properties with your account and you want to finance the rest. Well, when thinking about real estate investing, borrowing money kind of goes hand in hand with that. But the problem is you have to have something called non-recourse financing, meaning that in the event of default, your IRA can't pay, the lender can only come after that property. And a lot of banks just won't get into that space. There's a few out there that do it. And obviously Titan Bank is a great leader in that space and specializes in it. So maybe give us an overview of kind of what the typical metrics that you look for in it. Because I know that these are very specialized loans. There's some things that you just don't do, but kind of get, focus shortly on what, kind of is the no-go stuff, or if a client wants to buy property, what kind of stuff you won't lend on. And then maybe kind of the stuff that you will lend on, and what the process looks like for, from someone contacting you saying, hey, I want to finance this property purchase. What does that look like from your perspective?
Sure. So the good thing with us is we lend nationwide. So we go all 50 states, all continental. We the continental U.S. And the one thing, the process is really the same as you would on a traditional loan. If you're going like a Fannie or Freddie or Jenny, those type of products. The process itself, there's still appraisals, there's still title. You still have obviously insurance. So all that is all the same. Like you mentioned, Alex, is the big difference is there's not the non-recourse. There's no personal liability, so we can't go after and put a lien on on the individual or put judgments or collections on their credit. It's all the money's lent to the retirement fund, and then of course all we can do is go after the collateral, the actual property. The one thing people with non-recourse, because it's not recourse, it's a much larger down payment than you would on a traditional financing. So typically you might be able to get a 5, 10, 15% down payment on a traditional, or maybe 20 on an investment property. With non-recourse, you need anywhere from 35 to 40% down payment to go ahead and qualify for that loan. So that's the one thing where it comes back, and everyone wants to get into real estate with their self-directed, but then they don't realize that, I got to put down 40%. Or 35 to buy that property. So that's one thing. That's the main thing you want to look at is your actual down payment and reserve. So 35-40% is a good is a pretty good baseline. Most lenders, there's only a handful out there, but it ranges from like I said, anywhere from 35 to maybe 45% down payment at the most is a safe number. And then you have to have some reserves. So you want to have at least 10 to 15% reserves of the loan amount afterwards. So that means 10-15% of, if it's $100,000 loan, you want to have about 15 grand left over. And that, that's for if any unforeseen, maintenance issues, AC goes out, you need to replace the roof, that's why you want to have it, because you can't use your personal funds. And now you could talk to more that, obviously talk a little bit about that, but you can't use your personal funds to do the repairs or any unforeseen maintenance issues, because it's in that would be, you can't commingle your funds, your personal and your retirement.
Yeah, that's a great point.
Yeah.
Yeah, it's a great point you bring up. And it's important for people to understand, especially probably the people that are going to be listening to this, because they're coming in saying, hey, I'd like to get involved in real estate, but I need some more money to do so. So we always recommend people, even if you're not using non-recourse financing, buying a property, utilizing the whole value of your account. Well, while that's all well and good, you may be able to afford it. If you have one issue come up and there's not yet any cash flow, or you don't have any reserves, you're kind of left in a really tough position for paying for that. So that's a good idea, on any ground of buying an asset that might have some maintenance issues, is having enough money in there to pay for it. Because like Ryan said, you can't just take money out of your own pocket and pay for an expense. Granted, you could potentially make a contribution, so your $6,000 or $7,000 contribution to an account to pay for that. But if you're talking about a $10,000 roof, your $7,000 contribution is going to still leave you, $30,000 short on that trip off that river, trying to get that paid for. So it's really good to understand. Now, is that a metric when you're using to qualify people? Do you require, at least when you're looking at that deal, that they have some in reserve, or is that just kind of a best practice measure? Is that something that you require on your qualification process?
Good question. We do. So that's a good question. We do require we require 15% typically. We don't hold it back. So, we only hold about of that 15%, 5% of it is where we want to keep it in the account. So we know they're going to use it, for if they need to repairs. So when you close the loan, we want to see that 15% balance in the actual IRA, in the retirement account after closing. So we want to be able to source that as what we could possibly go a little lower, but typically it's 15%.
Okay, gotcha. And is that a requirement for being in that specific retirement account? I know people hold a lot of other different accounts at other places, or would you accept a verified balance at another IRA that the client holds, or do you require it to be in the actual account purchasing the property?
We typically want to in our Titan, checkbook control account. We could make that exception for you guys, for your clients, that we would, if it's in your actual your account, then we could go ahead and make that exception, and we'd still do the loan for your customers.
Okay, great. Just always good to know, because I know people, with retirement plans, there's people that got 15 or 20 of them in different places, and they constantly move money around. So it's always good to understand. So let's talk a little bit about a deal. So someone comes in, they got a property. Let's talk about, some things that, you won't lend on first, and then we'll kind of get into the normal stuff that you see and some of maybe the potential issues that come up with those. So what kind of properties, because again, real estate comes in all former flavors. Will you lend on things like raw land, mobile homes with land, or kind of like what brings up to the qualification of the stuff where you will start lending on? What kind of stuff won't y'all touch?
The best thing, the best practice for us is we want an income producing property. Now you could have, raw land, you could have land that's income producing, but with us, we won't do, raw land. We won't do the manufactured housing. We're just not comfortable with that. We say we don't lend on condos and townhomes, but we do make exceptions on some of those. But for the most part, we stick to the 1 to 4 units, single family. We'll do commercial. So a true commercial, it's a little more underwriting when you do a commercial loan. So we want to actually go through the commercial process. So there are some nuances with that, but we're unique. The fact that we do non-recourse on just about all properties, with the exception of the one, the mobile homes, the raw land. We will do, we've done storage facilities. We've even entertained some actual RV parks. We won't do that anymore. It's just, it's a lot of due diligence, and it's too cumbersome for us to do those. So we won't do any type of RV parks. I get that question a lot, and but that's really it. Those are the main, that we won't lend on, as long as income producing, commercial, 1 to 4 unit, and the other important thing, the debt coverage is very important when you're figuring. So there's a debt coverage ratio that we want to see on the property. And that's your net income that's going to cover 125% of the principal and interest payment. So once you get your rents, you take out your expenses for vacancy and management and your taxes, insurance, you have a net income. And then we want to see that net income 125% of the principal and interest payment. So payments $1,000, we want to see a $1,250 in your net income.
Gotcha. Okay, that's definitely great to know. So again, has to be income producing. So that kind of brings up the question of fix and flips, because sometimes, people they want to buy a property and they just want to get into it, fix it, flip it out. Is that something that y'all do or no?
We don't do fix and flips. It's not that right now we are not doing any type of major rehab or fix and flips. We do more we're the long-term hold play. 25-year AM. We're there when you want to actually grow the appreciation with the property, not the short term. So that's not saying other lenders don't, but that's not what we lend on.
Yeah, okay, and not a lot of other people do, except for more of the small private, more hard money people that I've seen. So it's just always good to know if that's an option out there for people, because fixing and flipping, especially with how crazy prices on properties are going now. But rents are starting to really ramp up now as well. So getting something in that can be a long-term hold to rent out, you can see some really serious returns if you're buying property just to rent it out. I know locally here to us, I live in Pinellas County, the Tampa Bay area, and I believe it was New York Times or someone just put out a list, and we're in the top 5 of the average rent increases year over year for the entire United States. So, for people that say, oh, you make all your money in fixing and flipping properties, if you're seeing a year over year rent increase in your market of 25%, that's nothing to scoff at. Having something where you can buy something, being able to get into a property in an area by utilizing finance within your IRA, and then being able to capture all those great rents completely tax-free to the IRA is absolutely huge. So being able to understand how to finance properties, I think, is real important for people, especially coming into this. A lot of people change jobs in the past few years, have access to old 401ks. So understanding what your options are, within that structure of being able to acquire more money to buy potentially more properties is great. So when it comes to actually buying properties, now, you've kind of talked about what you don't do. So again, y'all focus on income producing properties, typically, 4 or less conjoined, do get into some commercial stuff. What is, kind of the typical deal that you see people, coming in with? And do you only typically do them as 25 to 30-year AMs, or do you get into shorter amortizations, balloon notes, adjustable rates? What kind of products do y'all offer as far as what clients go for, and what kind of deals are you seeing those made on?
Oh, that's a great question. So we do. I mentioned the 25-year AM. That's a fairly new product for us. We do anywhere from a 5-year ARM, 7. We could really structure almost any type of ARM product. So it's fixed for 5 years, 7 or 10, and then we can and it's based on either a 20 or 25-year amortization. Some clients like to do a shorter term amortization to build more equity. That's complete. From our standpoint, that's. We can set up the terms however they would like it, but the max we go is 25 years, and then most of our clients will do a 20-year amortization on a 10-year ARM, so they'll lock it in for 10 years. We base ours off of the Treasury index, so that's we go off Treasury plus 4. So in terms of the margin, I can get into more of that. It's pretty set right now what we're offering. That could change, but that's what we base our interest on. So
yeah, and if people want to get more of that, since interest rates change so much, I would just have them reach out to y'all, and obviously your contact information with regard to pricing on that stuff. But just understanding, obviously, you don't just have one fixed metric that you use. You go all the way down to 5 with adjustable rates. When people say ARM, we're referring to adjustable rate mortgages. Do you do so? And I'm assuming that at what point do you offer a fixed rate? Is it only at 15 and up?
We'll do a 10, 15, 20, or 25-year fix. So we can do all of the above. The good thing with us is that it is our money. We do service it. We can structure, really accommodate. We can customize each property with each customer or sponsor. So.
Yeah, that's great because I know, and again, not to name any other names, but some other national lenders that I've dealt with, I know definitely aren't as flexible as some of those kind of things. So it's great to have the option there for, really being able to tailor that loan into exactly what you want. Because again, being able, if you have the cash reserves and you really want to hammer down and, get a good chunk of the equity in that property, because again, that can be really important for other things. And not to get too far into it, but when you do finance within an IRA, you do have the consideration for debt finance income tax, which I would encourage you go to the website advantaira.com. I teach several different classes on what that means. So if you're using an IRA, it's something to be considerate of. If you use a 401k, it's exempt from that tax. But being able to get rid of the debt or increase your actual basis in the property is a real big advantage to when you finance with an IRA. So utilizing some of those shorter amortization schedules or just paying at a higher rate, even if you am it over a longer schedule, can be really beneficial in these scenarios. So again, that's a whole other can of worms. I am more than happy to get into those kind of nuts and bolts with people. So reach out to me directly if you have questions on some of the other consequential items for IRAs on a tax reporting standpoint. So let's get into some deals. So I know when we talked before, you kind of brought up some really interesting things that, in my 10 years, I had never really kind of thought of when it came to, maybe buying properties with a partner and then maybe, refining the property to get them out of it. So that way your IRA wholly owned the property or different kind of things like that. Maybe go into a couple different deals that you've seen that are a little bit outside of the norm where people have used your service maybe after the initial purchase to refi out other people or just some other cool stuff that you've seen because, just like I have dealing with IRAs for years, I've seen all sorts of cool stuff. So if you pop into your head, maybe kind of go through the high level of a few deals.
Sure. So that's a great point. So we do with us, we can do it. A lot of times, especially in the market that you mentioned, homes are increasing, they're selling. A lot of times our customers will have to go out and actually pay cash for the property, or I shouldn't say cash, use their IRA, all their funds. And then after the fact, we go back and we'll refinance it and put cash back into their IRA that they paid. And then they can go ahead and invest in other properties. Since it does take a little time to go ahead and, close on a loan, the seller may not want to wait 30 days. So they pay cash. And in that situation, they may use another partner. They may use another entity to do that. And then when we refinance it, we pay that partner off. And then, that way their IRA holds it solely versus having that partner involved after the fact. So that's one thing that we've done with customers. Also, we can actually do it where there's an entity that's possibly buying into another LLC and the IRA or the IRA or the solo 401k are buying into that LLC as well. And we'll lend to both of those entities, and we can actually title it, to the IRA at 50% and to the other entity 50%. So those are some of the complex structures we can do because not everyone has enough money to put down for the property, and they might need a partner, whether it's another IRA or it's a private company that's investing. We can do those type of structures as well, and to help you leverage and get into the game.
That's really cool. So in the context of this, if it was like a joint tenant in common, not utilizing like a entity, like they weren't investing into an LLC to buy the property, you would do the loan to essentially both of those buyers that are on deed then?
Yes, exactly. We could put both on the actual deed. Exactly.
Okay, great.
And split it up. So that's something, not something we want to do all the time, but we definitely can do that.
Yeah. And I know from speaking with other people in the industry, I know that's a hard no from some other people. So again, having that kind of option, especially with how expensive real estate is, or just however you want to structure the deal. Maybe you have someone else that, wants to get in on real estate and they need a partner and you want to have your IRA, bring someone in. That's, also a really great aspect of being able to have those kind of options. Now, I want to kind of get a little bit into your other services because lending is great. And, the high level stuff, I think is what people really kind of need to understand is that, we have, someone here that can lend your IRA money. Because remember, you can't just dump additional IRA, non-IRA funds into your IRA. You can't just say, hey, I have 50 grand in a money market. I want to put that into my IRA. There's some specific scenarios with using things like SEP IRAs and 401ks, which again, are really specific use case. But for the vast majority of people, the money that you have personally has to stay out of that IRA. You can't just dump it in or help, float an expense or something like that. So being able to finance that real estate purchase is something that we're seeing more and more of. And, we definitely have a solution, for a bank that can help with that. What are the other cool aspects, though, of what Titan Bank does? And it's something that I will say 90% of the time that I deal with what are called our do your own 401k clients run into is opening up a bank account. So if you're not familiar, a do your own 401k is when we, as a company, if you want to set up a solo 401k, we will rent you the 401k plan documents, and you kind of in a cafeteria style, you'll go and pick out, okay, I'm going to bank with this bank. I'm going to use this for my accounting firm. I'm going to do all of the cash management here and record keep my funds. The problem is, though, is that if you walk into a Bank of America, and I literally just had this happen with a client not too long ago, she took what's called her adoption agreement, which opened the 401k, the letter that I gave her, and they literally could not wrap their head around it, even after talking to a manager of the B of A branch, of what exactly she was trying to do. It went all the way up over into the Merrill branch. They were just, steam was coming out of ears, and they couldn't figure it out just on simply opening up a depository bank account. So I'm thrilled that we have someone, a direct plug-in. We have a few other people, but it's great to have someone that can do this. So, tell us a little bit about the services that you offer to people, maybe that are doing checkbook control or do your own 401k accounts, what that looks like for y'all, if you offer any additional services, if it's mainly just depository and check writing, because I think that's a really good benefit to people listening to this, is that you offer depository services for some of the more niche IRA stuff that people do.
We do. So that's what we really got into. That's what we specialized in. We added in the non-recourse after the fact, just because we had a lot of people requesting it, and that's why we got into the self-directed space in the first place. Is in the checkbook control, for the solo, for your do-it-yourself, 401k, is we had so much frustration with customers. Some of our small business customers, set these up, and then they couldn't get them. They couldn't go to B of A or whatever. They couldn't go to their big banks. Or worst case, they did get it set up somehow. A branch or whatever, they got it set up. And then all of a sudden, 6 months later, they get a cashier's check in the mail that they closed their account because they got audited and they don't support those type of accounts. So then they're scrambling to try and put that money somewhere else, and concern. So that's why we opened up this department to handle the checkbook control. We literally give checks. You can do online wires, ACH transfers, everything at your fingertips on your computer. We can set them up, obviously online. We have an online application that they can go in and upload their adoption agreement, the plan documents, and then also, of course, it takes maybe 5-10 minutes to go ahead and fill out the application. So it's a very seamless, easy process. We support all 50 states. So we are federal insured, FDI insured up to 250,000. So it's from that standpoint, it's a full blown commercial checking account for the most part. It's just it's underneath that actual plan that the do it yourself 401k.
Yeah, exactly. And a lot of people like that aspect of the DYO, do your own 401k, because it's cheap. We charge people $300 a year to do those things. And obviously if we're doing cash management and stuff, we have to keep the lights on and everything. And there's a lot of servicing that goes into it. But if you want to take care of the record keeping and you just need a cash account, it is a lot harder than you'd think to find somewhere that can open it, and even harder to probably find someone that can do it as seamless as Titan does. I will say from my 10 years of experience, as far as seamless integration with stuff like that, this is pretty much the best one that I've seen. So, we have options for clients, but if you're looking for someone, they definitely offer that service. And also, will you also open up checkbook control accounts for people that use LLCs that their IRAs own, or do you not get into like business checking accounts?
We do. No, absolutely. So you as the custodian in event, you can have the IRA LLC, and we'll open up the LLC. And we have a lot of customers that do that. Maybe they need that maybe they're investing in crypto or which is we're okay with, as long as it's a U.S. based exchange. So, we have some clients doing that, and they want to tie again with the title companies, with real estate. I mean, they're buying tax deeds and liens. I mean, it's a lot of times you need that bank to transact, for those things. So absolutely, we can. You keep your Advanta account, and then of course, as a custodian, then we just offer that check writing coincides with their Advanta account as well.
Yeah, those are a lot easier accounts for most people to open because it's just a business checking account at the end of the day. But the real benefit is that do your own 401k, which can be nothing short of a nightmare for people. So having a solution for that is fantastic. Now we're kind of getting up towards about the end of when we like to do this stuff. Are there any kind of, interesting deals or anything else that you wanted to hit on, or any other services that y'all might offer you think would be a benefit for IRA clients to be aware of?
I mean, just, we do have the option to have multiple accounts, so that's another thing, they can set up, if they have a bunch of LLCs, so that's all in there. So that's great. They don't have to sit there and do 6 applications. They could technically do 1 application and put all their subsidiaries or affiliates in that application on that dashboard. So we support, multiple accounts, structures, especially with people investing in real estate. They may have 10 different LLCs for 10 different properties. Sometimes they structure it that way, and it just makes it it's easy use. They can have it all on one dashboard. It's all there at their fingertips. Where versus having to have multiple logins. So we do that as well. And then we're looking at some other things, but right now we focus on the real estate transactions. Of course we do SBA, Small Business Administration loans as well. We do true commercial loans. So, we're a commercial bank. And so that's, we absolutely can help if they have other businesses want to expand. We can look at those loans outside of the non-recourse as well.
Awesome. And do y'all have any brick and mortar locations, or are you all strictly online?
We are brick and mortar. We're brick and mortar in Texas. So we're not we may operate similar to a fintech type bank, but we are an actual brick and mortar in just outside of Fort Worth. And then, but everything else, pretty much everything is done online with these customers, and no one really wants to go into the branch, but they definitely could.
Yeah, the only time I ever need to get cash is if I need to go to banks, if I need to get a cash that the ATM won't let me get out or something nowadays. So it's good to know that y'all have that for people. Since we're getting to the end of it, give a shout out for your contact information and where people can reach y'all on your website and everything like that.
So it's just titanbank.com. And then my email is rhughes, so it's RHUGHES @titanbank.com. And I can give my direct line is 214-580-3187.
All right. Thank you very much, Ryan. Again, I really want to thank everyone that tuned in today for this edition of the Alternative Investing Advantage with Advanta IRA. My name is Alex Perny, and until next time, I hope everyone has a great day.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.